And as you can see, the back and forth, emotions, deals, bombs, agreements, breaking of agreements, and all the stuff that's been going on in the Middle East does affect the markets. It affects oil prices, and oil prices affects airlines. It's all interconnected to some extent. So I'm not going to get into a whole rant about what's going on in the Middle East right now, or give you my opinion about it, because that doesn't matter. What matters is the markets yesterday kind of looked at. It's interesting that when there was before the ceasefire conversation, there was some talk that Iran was going to close one of the ports, the Straits of Hormuz. And so the market reacted to that initially, which is interesting. You could look at, you look at any chart, but let's just look at the SPY. We'll look at, I guess you could look at 15-minute chart, but pretty sure that announcement came out yesterday morning, I think. Was it? I think it came out here. Yeah. So when Iran said, "Well, we're going to close the Strait of Hormuz," and it didn't look like anything positive was going to come out of what was going on over there, the markets immediately reacted to that, and then they kind of went back to the old ceasefire conversation, and then the markets went back up. Obviously, there was an abundance of puts as well, as people were trying to short this thing. The market responded, went down there, tag it, and then popped up. Typically, what you'll see on 0DTE, and it's happening today, is that initially when there's in the morning, when there's an abundance of calls, when there's more call out of the money calls, let's just keep it to SPY for now, the market has to go up there first. And the reason the market has to go up there is because the market makers have to buy stock just in case they have zero control and they get squeezed, and we end up at 609 at the end of today. Well, what if they end up at 609 and there's 599s, 600s, 601s, 602s, and all on up, right? And we finish at 609, and all these call holders say, "I want to exercise." Like, why wouldn't you? If you were holding on to a $600 call, or a lot of them, and you were an investor, you would take assignment, would you not? Would you like to own the SPY at 600 if the close today was 609? Yes, is the answer that you're looking for. You would. So in order for you to take delivery of that stock at 600 at the end of the day in this hypothetical 609 close, some entity needs to have, let's just say you bought, we'll keep the number simple, 1,000 calls. Well, 1,000 calls, ladies and gentlemen, is 100,000 shares. And 100,000 shares, value-wise, of this beautiful stock is, get rid of that comma. Remember when you learned this in grade school? 1, 2, 3, comma, 1, 2, 3, comma. It's $60 million of SPY. $60 million of SPY for one trader that bought the 600 calls today, and market maker couldn't stop it, got squeezed. Yay, we have peace in the Middle East. Every NATO country is going to pay 5%. The world declares peace, and up it goes, and we end up at 609. And again, the 600 call holders from this morning that bought it this morning, at the end of the day, of this hypothetical day, decide to take possession of these stocks, of this stock. Well, there's got to be an entity that has $60 million worth of the stock to go to this individual, right? They're certainly not going to want to buy it up here, are they? Are they going to want to buy it for this amount? I don't think so. They're not going to want to lose almost $1 million. So does everybody understand why the market maker is buying this up this morning? Does everybody understand now? Because it's counterintuitive, right? The counterintuitive aspect of it is, well, if there's a whole bunch of calls up here, wouldn't the market maker want to send the price down away from it so that they're not in the money? Well, yeah, eventually they will, but that's not what they have to protect themselves first. So when there's an abundance of calls, right, the market maker buys because they got to make sure that they have enough stock to cover them just in case. Then they take a look at the puts and see, well, are they starting to take profits? Are they starting to buy puts, or are the put holders all of a sudden, starting to gain some traction? Because if they do, then they start selling off, and they start selling that stock, driving it down here, because they have to cover. They have to raise cash to cover in case something happens and we drop down to 590. Oops, you better have some cash, because then the market maker would be potentially responsible for buying back at this price. They're not going to want to buy at 600 if price is down at 590. So they start selling off, and at the same time, the call holders go, oh crap. So they abandon their calls. And as soon as they've abandoned enough of their calls, guess what the market maker does? Buys some up a little bit here. Why? So that the put holders will then give up. And they'll park price somewhere in the middle to exact as much pain up here and down here as they can. And these are the swings of the market throughout the day, controlled by 0 days till expiration, options traders, and the market maker trying to F them over as best they can. And that's what's going on.
Thanks for watching. Hope you enjoyed this video from Trade With Me Now. Make sure to go ahead and like this video and subscribe to our channel so you make sure that you catch our next video right when it's released. Also, if you have a question or comment, please leave that in the comments section below. And of course, if you want to learn more about Trade With Me Now or join our community of profitable traders, go to tradewithmenow.com. There's also a link in the description below.